Good morning, everybody. Hope everybody's having a great day so far. Hope you enjoyed that 15 minutes of Kenny Glick. Time to get to you know who. Tom Gentile in 5, 4, 3, 2.
Hey everybody, Tom Gentile. Welcome to Power Profit Trades. You know what we do here. We teach you how to spot opportunity, create alternative trading strategies, and of course, plan, execute, and manage those strategies. Wednesday, January 5th, 2022. Here's what I got on the docket for us today. I want to talk about put selling right off the bat. Okay, we're going to talk about put selling and secured put selling. I want to show you how 2021 ended up for me. We'll take a look at some details in the fourth quarter and get set for a great 2022. To do that, we're also going to need to look at our cheap and expensive option list. That is another one I want to take a peek at. And then finally, we're going to go back once again to the Flying Five, because I want to show you how to take the Flying Five and sit in the cheap seats for this particular trading strategy. So good morning to all of you out there. PGA, awesome. Teresa and Mike, good morning as always. And of course, good morning to the YouTube crowd. So we are streaming live on YouTube as we do every Monday through Wednesday. I will say this, next week, guys, we're going to have a programming change. We are going to be coming to you at 11:30 on Monday, Tuesday, and Wednesday. And part of our week together will be with Nick Black. So this is exciting stuff. Nick and I, best of investing crypto, best of trading crypto, getting together, knocking heads, probably agreeing on a lot, agreeing that we're both going to continue to make a lot of money in this space in 2022. So very excited about that. And I hope you guys can join us starting next week. All right, so let's go ahead and get right into it here. I was looking at the markets this morning, and we're getting a little bit of pullbacks here and there. The market just can't go up forever. We're going to get a little bit of pullback here. Interestingly enough, and if you were on Monday Morning Live this morning, then you heard about it, that the Dow continues to lead the pack, while now there seems to be some selling going on in the tech-heavy NASDAQ industry. I am in full agreement that I believe the Dow is going to be the leader for 2022, which is why I am so interested in these Flying Five stocks, why I got into them with all of you. If you saw what I was doing, I put roughly, give or take, about $250,000 into the dogs of the Dow yesterday. I showed you exactly how I did that, and I back ran that for you, which means that I gave you the trades, right? I gave you the strategy. I gave you the trades I was going to do on Monday. I actually did them yesterday. I showed you an alternative way of doing that with call options. We're going to revisit day 1, day 2, and then, of course, we're going to take a look at spreads. So let's get started first with put selling, because I had mentioned I was going to talk about this. This is one of the best strategies for 2021. All right. It's actually been one of the best strategies that I've been doing since the pandemic started. Right. That's what got me all interested in this. And so, to take a walk down put selling lane, let's talk about something called statistical probabilities. Okay. Now, statistical probabilities tell us that if you're starting right now and you're looking forward, statistically, in terms of a coin flip, we have about a 50-50 chance that the stock market is going to be up versus down today, by the close, by tomorrow, by next week, by next month, by next year. Those statistics will change slightly, right, when you're taking a look at something called log normal distribution. Right? I'm not going to get into all the big words. I don't want to big word you to death here. But think about a stock for a moment. If you buy a stock right now, let's say we bought Dow Chemical right now. So Dow Chemical, between now and 15 minutes from now, could be higher than we bought it, could be lower than we bought it, based on bids, offers, fear, greed, whatever that may be, something that's going to push that stock higher versus lower. Okay, that's a statistical probability. If we go out and we look at, we look at buying any stock by throwing a dart at a stock and picking that stock and buying it, you really do have a statistical probability. How do we get outside of statistics? Well, some of the ways we do that is by looking at rules-based trading, by looking at historical patterns. Historical probability, completely different than statistical probability. Historical probability means we're looking into that stock, the past of that stock, maybe applying some rules to it, back testing those rules, seeing how it did in the past to give us a projection of what it may do in the future. That's historical probabilities. Statistical probabilities are literally present looking forward, right? We're putting something down right now, even with historicals, no matter how good something looks in the past. We move to the statistical side when we place the trade. Statistically, stocks could be up versus down. All right, great. So from here, how do we change statistical probabilities to put them in our favor, right? Going to talk about that right now. So if there's a 50-50 chance with stocks, can we raise that chance? Can we raise that statistical probability? Yes, we can. And it involves options. Options give us the ability to raise that statistical probability. The way that's done is by going outside of the 50-50 realm, and that means let's take a stock that's $50 a share. Now, what is the statistical probability it's going to be above 75 by the end of the day today? What's the statistical probability it's going to be below 25 by the end of the day today? Much, much less. I would imagine, and we're just spitballing here, but I am imagining that we have maybe a 1% chance, especially if the stock opens at 50, that it's going to close above 75, or that it opens at 50, it's going to close below 25 in a day. That might be a 1% chance that's going to happen. That means there's a 99% chance it's going to stick in between 25 and 75. The farther you go out in time, the more these statistical probabilities will change. Okay, so what about the chance of a stock going above 75 or below 25 by the end of the week? Right, that's going to be a little bit lower of a probability. What about the end of the month? A little bit lower. That means that, maybe we have a 5% chance that it's going to be above 75 or below 25 by the end of the week. Maybe there's going to be a 10% chance that it's going to be above 75 or below 25 by the end of the month. See what I'm saying? Statistical probabilities are, they have a lot to do with the range of that stock, the volatility of that stock, and the time it's going to take for it to get to a certain level. All right. If we use options, for instance, and I sell the 75 calls and or I sell the 25 puts, I'm selling out of the money premium. Now, how do you learn about that? Well, it's very, very simple. All right. How many of you in the room right now, show of hands or show of chat, put it in the chat box. How many of you bought an out of the money call option only to see it go to zero? I have. I've done that, been there, done that. Now, what you experienced was a statistical probability that was severely against you, as did I, when I used to think that options were like stocks, but cheaper. This is the first lesson that a lot of us learn in options, is that, options are just like a stock, but they're much cheaper. Yeah, they're much cheaper. And I used to also think that if I could buy an at-the-money call for $10, why don't I buy 10 out-of-the-money calls for $1 a piece? It's the same thing, but I'm getting 10 times the leverage. Yeah, you might be, but you're also reducing the probability you're going to be right by at least a factor of 10. So why not flip that script, become the house, and sell that junk to somebody else? And that's what we're looking to do. Now, if we sell call options, all right, versus selling puts, is there a higher risk associated with that? Absolutely there is, because while a stock can go to zero, all right, the lowest the stock can go is to zero. A stock could go to infinity to the upside, right? We saw a stock just today, just this morning, all right, that Kenny was referring to as my nuts. And that was up double. That was up 100% in the pre-market, right? So that was a $10 stock that all of a sudden was a $20 stock before the open of the day. So stocks can go to infinity. There is no telling where a stock can go to the upside, but we all know where a stock can go to the downside. So let's eliminate selling call options. First of all, again, you have that unlimited risk. Second of all, your broker probably won't let you do it unless you got a lot of capital. So let's eliminate that. And let's talk about something called cash secured puts. What I mean by that is instead of buying the stock at 50, how about we force ourselves to buy it at 25? Now, if we force ourselves to buy something at 25, we're going to get paid to force that, right? It's kind of like placing a limit order at 25, but getting paid to place a limit order. And that's what a secured put is. A secured put means that we are looking to sell put options, all right? Selling put options will obligate you to buy the stock if the buyer of the put exercises his or her right. Now, in order to take the obligation, you're going to get paid a premium to do so. And I'll say it, I've said it before, I'll say it again. Cash secured puts, one of the highest probability strategies to create wealth. I'm not talking about rich, I'm talking about wealth. There is a difference, okay? Wealth, this is longer term wealth. So some of you sitting in the room right now, you're saying, Tom, you're wasting my time. All I want to do is learn about buying calls and buying puts. Well, I hate to break it to you, but my job is to help guide you down the road of success. I don't want to guide you down the road to Las Vegas, all right? We're not spinning the sixth wheel here, right? Anything that I do that involves calls or puts has a system or a historical pattern associated with it. Anything that I do that involves selling puts, well, that has a pattern as well. But one of the patterns we can all learn about in here, and that's how about creating a higher probability trade? Okay. All right. So let's kind of move down the curve here a little bit. Let's talk about selling puts step by step. So for those of you who've never done this before, right? Selling puts step by step. So let's say that we're looking at a stock and we're going to call it XYZ. XYZ is trading, let's say XYZ is trading at 125. And I were to sell the 100 put. Now, I could buy the stock at 125, but if I sell the 100 put, what am I doing? I am setting myself up to purchase the stock at 100 if I am assigned, all right, or if the buyer of the put exercises that put to me. For that, at the time, let's say that 100 put's trading for $10. Somebody's going to buy it, expecting the stock to go down. I want to sell that put because I'm expecting the stock to, who cares? If it goes up, I keep the premium. If it goes sideways between now and expiration, I keep the premium. If it goes down, I keep the premium. Now, I might end up with the stock too. But what I've done is I've created a high probability situation because the 50-50 chance occurs at where the stock is today. And if the stock's at 125 today, the 50-50 chance is at 125. At 100, I have a greater than 50% chance I'm keeping that premium. But in the event that it goes down, I'm still going to keep the premium. And you know what else that happens at 100? My break even is still better because if I took $10 in per share on a $100 stock, I'm sitting at 90 on my break even. So now, are we always right with this strategy? No. Can you lose money with the strategy? Yes. But if you follow a set of rules, you can put yourself in a situation where you're in a much better position than, say, someone that's just selling puts at throwing darts at a wall. Let me show you what I'm talking about. Where is it? Take a look at this. This is our Rocket Wealth Initiative performance for 2021. Okay, I got all the puts over here. These are the ones that we sold. See where it says short? That's the short. You know what you need? I'm missing something, guys. I'm missing something extremely important. I apologize. I had to reboot my computer this morning. This is what I'm missing. I'm missing big old mouse. There's big old mouse. There it is. All right. So once again, here is the puts that we've sold in 2021. You can see there's quite a few of them here. All right. And then what else do we have here? Obviously the symbol. The trade is a short. Now, you'll see something down here called long short. Okay. That's another way of selling premium, but by doing it with a spread. Much, much cheaper. Right. Now, in fact, you know what? I'm going to get into that later today. I'm going to get into that at our 1 o'clock session. But obviously, open dates, this price in the quotations, this is what we're bringing in for that premium. Sometimes it's a little, and sometimes it's a lot. Close dates. The close dates are typically, look at there, a lot of them the same day. 1/15/21, 1/15/21, 1/19, 2/19, 2/19, 2/19, 2/19. You know what those usually correspond with? Expiration Friday. And then you see over here, 100%, 100%. There's a 75. Okay, so we didn't take in the entire amount of premium, but got most of it. 100%, 100%, 100%, 100%. That's because the premiums went to zero. We took in and captured 100% of the premium. Okay, so this is our track record for the Rocket Wealth Initiative. You can see it here. And yeah, there's some losers on the board. Not gonna say there isn't. I have not found a single strategy going long term where you didn't find a loser or two. All right, we'll get back to that. But in every case, you're opening this as a short put and you're closing it. You're buying it to close. All right. Again, when I sell the XYZ September 100 put, as an example, it obligates me to buy 100 shares of XYZ at 100, but I get paid $10 a share to do so. Now, what's my risk? What's my reward? What's my break even? Let's go ahead and set it up. Risk. If you buy a stock at $100 a share, what's your risk? It's $100 a share if the stock were to go to zero. So if you sell a put option, a 100 put, then you are on the hook for $100 a share, just like the stock. The difference is, with the put, you got paid. With stock, you didn't. Okay? So keep that in mind. With the put, you get paid so you can take that premium, and that comes off of the risk of the stock. So $100 a share minus $10 I got paid for the put, so my risk is 90. Still, it's a lot of risk, but less than the stock. What's my reward? My reward on the trade is the premium that I brought in. So if I'm looking at a $10 reward, that means the most I can make is $10 on this trade. Why in the world would I ever put a trade together where my risk is 10 and my reward, or my risk is 90 and my reward was 10? Two reasons. A, I'm doing this on first class stocks. Maybe I want to own the stock, right? Did this on Expedia earlier in the year. Let me just show you. Let's bring that back up again. Take a look at Expedia. Where's Expedia at? I was looking at this earlier. There's EXP. Okay, so you see the EXP? This was the August 145 puts, right? 145 puts, and then we ended up, this trade actually went against us by 118%. It was a loser. We got put the stock. If you held this trade, you ended up getting put the stock. Where's Expedia at these days? First class stock. Let's go take a look and see. It may be up, it may be down. Okay. EXPE. All right. EXPE. 190. Okay, so I got put the stock for 145 and now it's at 190. So what did I get? I got the premium, I got the first class stock, and now the first class stock's up like 25% from where we were put the stock. Selling on first class stocks does make a lot of sense, all right? Now, let's bring this back. PTON I had on the screen, and I'm going to come back to Peloton because there's an interesting development on Peloton. I'm not saying it's a trade. I want to show you this as an example of why this might make an interesting play in this area. Now, what we do is we look at risk, reward, and break even through a number of different ways. Software you can do, okay? Your broker might allow you to do this, right? I do this right on my own software. And this is an example here of out-of-the-money puts with Tesla. Tesla, the out-of-the-money puts at 700, okay? Now, this is when Tesla was trading at over 1,000, and yet the 700 puts. And this was with, I believe this was 2 months to expiration, 2 to 3 months. And they were selling 30% lower than the stock price. Actually, no, it was actually closer to 50. I remember we were looking at this as a 50% off trade. You were still getting $12.50 to buy Tesla well below the stock price. Okay, so that's how we put those together. So what we do is we spot the opportunity. I'm going to show you actually how to do that here next. Create that alternative risk trade, and then plan, execute, manage. Plan, execute, manage means you go to your broker site and you put in the required information. Tesla put, I want to sell to open. I want to sell to open. What am I looking to sell to open? What's the expiration? What's the strike price? How much am I looking to get paid on? And so forth. Now, a lot of folks think, oh, I'll just do this on expensive options. Okay, we could do this on expensive options. This is a look at the most expensive IV right now that is currently out there as of the close of yesterday. All right, KWeb is at the very top. This is right now. I can tell you right now. This is a group of stocks whose options I would not buy. They're too expensive. Hey, Ryan, where do you live right now? Where are you living?
Sir. I am in the great state of South Carolina.
As the real estate prices in South Carolina been going up?
Dude, they are exploding up.
Yeah, it's crazy, isn't it?
Yeah, it's insane.
Suburbia is just, let me just give you a reason why I'm even talking about this, because it has a lot to do with expensive options, but expensive real estate. So Sarasota, Florida, is becoming one of those top 10 cities to move to. In the Tampa area, actually, and Sarasota is kind of that Tampa, St. Pete, a little bit farther south. I love Sarasota. Great place to live. A little slower vibe, and anyway, we've seen the house prices. Now, when you're looking at housing prices in Sarasota, if you're looking at houses that are above the $5 million range, they've gone up a lot. In that kind of $2.5 to $5 million range, I mean, they're there. They're not going up like crazy. But I'll tell you what's going up. What's going up is the sub $500,000 housing market in Sarasota, because first of all, it's almost impossible to find a house for less than $500,000. And these are houses that were selling for less than $250,000 even a year ago. Now, I'm looking for starter homes for my sons. Okay, my sons are ready to get their own starter home. Of course, Daddy here is going to help them out a little bit, but we're looking around at homes, and I'm telling you, I went to go look at one yesterday in a really great starter home, a great community, and you know what? I'm sitting there. I got my pickup truck, so I roll over in my Ram. So I'm sitting in the driveway. I'm waiting for the realtor. 3 people pulled up thinking I was the seller of this house. Hey, are you the owner? No, I'm not the owner. Drive off. Hey, are you the owner? Hey, you know what they think? They look at me and they think I'm the owner first. Then they see the pickup truck and they think I'm probably in there fixing the house up, ready to be sold. Finally, another guy comes rolling up his Mercedes. He goes, "Are you the owner?" I said, "No." He goes, I said, "I'm waiting for an agent." He goes, "Well, if the agent doesn't come," he flips his card out at me. He's the agent. And what's happening is really amazing. The sub $500,000 housing market in Sarasota, it's probably happening in a lot of cities. It's like people are trolling the neighborhoods. You got 2 types of trolls in the neighborhoods. Number one, you got people looking for housing. They're driving around because Zillow doesn't show you every house that's for sale. So they're looking around. They're taking pictures of the for sale signs. They're calling realtors. They're trying to get into houses, and these houses are moving so fast. I mean, I'm waiting, and the next door neighbor comes out. Her house is for sale too. I said, "Hey, you got your house for sale?" She goes, "We sold already." She said, Four investors. I mean, she was happy to open up and tell me absolutely everything, more than I even needed to know. She says, four investors came up, pulled money together, bought this house. We don't even know where we're going yet. We're building, and we need a house for 6 months. And they already got the house rented. They're ready to rent it. I'm like, wow. And so, anyway, I'm waiting for the realtor. The realtor comes in and she goes, well, we are, take a look at the house. We're not accepting any offers until the end of the week. Smart move, because, and I said, well, okay, well, I looked around and I'm like, all right, thank you for showing me the house. And I said, and so I said, you're staying? And she said, well, yeah, I've got another one coming in at 5:30. I've got another couple coming at 6. Literally, she was planning on staying there till like 8 o'clock because there were people coming in to look at the house. And this house is going to end up, I don't know, Ryan, how your area is going. This is going to go over list by, I want to probably say 10-15% over list price.
Yeah, that's about what it is here, and people are just like throwing cash at the sellers, trying to get them to go over, because they're appraising still at the same amount, but whenever they sell for 10, 15, 20% above market price, like,
yeah,
that's when it starts getting a little hairy.
And if I had a real estate channel, I'd spend time talking to everybody about what I do in the real estate market, which is not go chasing houses and overpaying for them. I'm not used to overpaying. This is weird. It feels like we're living in California over here now, where it's just a norm. You set a house price, and it's how many people want to bid over it. It's just never happened here before, but in the last year, absolutely. Okay, where am I going with all this? Because that's kind of what's happening with the K-Webs of the world, the Pelotons of the world, Team, Hubs, even Pfizer and TLT. And of course, Alibaba's been on this list off and on now for the last couple of months. But, I mean, here's what's happening. I mean, people are knocking on the doors right now of Peloton. They're paying whatever they can to buy these options, just like real estate agents are going around knocking on doors here in our city, trying to get people to sell their homes. But, it's like, where are you going to go? Why would you sell the home you're in right now if you got to go out and find something and overpay? If you're going to get overpaid, you're going to be overpaying. It's just the way it is. And so what's Naples looking like? Is it as bad down there? I mean, I would think Naples has a private airport or semi-private airport, so it's not as easy to get in and out. What do you got to do? Go to Southwest Florida International? I think that's what that airport's called. I don't know. Anyway, we could go sideways all day long here, but I don't have the time, guys. I went way over setting up the analogy for what we're looking at here. So let's take a look at Peloton for a moment, and I'm going to show you how I set up these high probability trades. So Peloton, and I had it on the board here, and I'm going to bring it back up again. Here's Peloton. So take a look at what's going on with this stock. All right, we're only going back a couple of months. This is 40 trading days, and you can see here back at the beginning of November, we're talking about the stock trading in the mid-50s. This stock has rotated down where it's now trading in the mid-30s, low 30s actually, $33.82 a share as of yesterday's close. In fact, you know what? We could, we'll take a look at it in just a few minutes. But the other thing I want to mention is the green line here. Now, I put different colored lines up on these charts quite a bit. This green line, this is our 60 to 90-day at-the-money IV, all right? Basically, that's just a big word for volatility, for options volatility. The option volatility for the 60 to 90-day options. I'm looking at the 60 to 90-day options because we're looking at this as a little bit more of it's kind of an in-between between the income trader and the investor trader. If you're going to be in the trade for 60 to 90 days, some of you might say, why don't you just sell the 30-day options, Tom? I mean, I could, but what happens is, again, got to get into the Greeks, and I got to get into, you got higher gamma. You basically have higher day-to-day risk. Get out of that day-to-day risk a little bit. Sell something that's in that 60 to 90-day range. It lowers your risk. It also allows you to go farther out away from where the stock price is. Now, this stock looks like it's an airplane that's landing. It's landing rather quickly. as you can see this thing coming down like this, the trajectory on this has this thing going below 30 and into the 20s within the next month or so. So we've got to find a way to trade this stock and put ourselves in some sort of safety net if it keeps going down. That's where we go to step 2, right? So first of all, is Peloton a first-in-class stock? I don't know. I mean, I have a Peloton. I don't use it as much as I used to. Now I got a rowing machine. Got a rowing machine for my wife for Christmas. You know who's been using it since Christmas? Well, actually, I've been on the COVID train since before Christmas, but I kind of like that rowing machine. And so in Sarasota, this is where the World Rowing Association is now, right down here in Sarasota. But I don't plan on being part of the rowing association. I just thought, hey, this is not a bad way to get some exercise. Anyway, so I see this stock coming down. Where's the safety net? Well, the safety net I find by doing something called probability cones. And what probability cones do, if I can show you here, is I am snapping a cone and getting an idea of what we call the statistical probability. It's a statistical probability right now based on what's happened in the past and coupling that with implied option volatility. And that's how we can set this, is that we have right now a statistical probability of 68% we're staying in the blue cone. We have a probability that we're going to stay in the red cone by 95%. Now you got an earnings report coming out in 30 days. That means the earnings report is going to come out on February the 3rd. So that's going to be an event that's going to pop this thing one way or another. Now, if you look at what happened last earnings, let's back it up a bit. All right. And we have to go back. Let me go back 60 days. See if I can get that in here. There you go. Look what happened in the last earnings report. The last earnings report we had come out, this stock was trading right around 90, 85, 90. And then pop goes the weasel down below 60. That was a huge, huge drop. All right. 35% off in one day. That could happen again. So either we go into this trade thinking we want to be out of it before earnings, or we need to go deep past earnings and try to grab some longer term, some sort of longer term trade. Okay. What I would be looking at on this one is I would be looking at the probability cone and saying to myself, all right, 40 days out, I need to be down here somewhere around 20. All right, 20 or below. Let's look at the stock and option tables. So the stock and option tables for February, I'm going to look at February, I'm going to look at March, because that's your really that March trade is the 60 to 90 days. But if you look at February, and I even got to go lower than we are right now, we need to really get deep in or deep out of the money, deeper. I'm going 50% down, guys. 50% down is where I got to go with Peloton. All right, so now here are the 20 puts for Peloton. Let me blow it up so everybody can see it. There's the Feb 1820 puts. They're selling for 36 cents. I don't like that. I don't like taking in 36 cents and risking $20. All right. Well, does March give us something any better? Well, March, I see the 20 puts for 58 cents. All right. So if I were to sell this put option right here, I'm just going to throw this on the board because I want to see what it looks like. And we're going through risk. We're going through earnings, which have already shown us a lot of risk. So there's a possibility that, I'm going to take in $58 for this trade, but I'm going to risk $1,942 going through an earnings report, which could go either way. Okay. What could I do? I could credit spread this thing and hedge off some of my risk. But the problem is the reward to risk ratio is going to be a little bit lopsided. So what does this tell me? Well, it already tells me what I already know, and that is that Peloton, in my mind, it doesn't hit our smell test, is not a first-in-class stock. First-in-class stocks are stocks that are tops in their industry, okay? Peloton is not a top in industry. Peloton is, it's not even a one-trick pony. It's really kind of like a three-trick pony. And what I mean by that is they've got a couple of products. They all kind of in the same area. They're not profitable at all. They really don't have. I mean, they keep saying they've got a timeline, the profitability. I don't know if that's going to happen or not. I think that as we get past Omicron and we get more into the reopening trades, this is not a reopening trade. So there's definitely some risk to this particular trade. But when I look at these and I think to myself, well, what does make a good trade? We're going to talk about that at the 1 o'clock hour when we get into Rocket Wealth. We'll talk a little bit more about what that looks like. But I will let you know this is that what we're looking at is we're looking at first class stocks. We're looking at stocks that do have high IV. They may not be on this top 10 list. Just because it's not on the top 10 list doesn't mean it's not expensive. Okay? It just so happens that everything on this top 10 list that you see here, maybe with the exception of Pfizer, is not a first-class stock. Right? It doesn't fall into the range of a first-class stock. That Peloton looks like a stock that could go to zero or could get very close. Peloton is not a stock I want to own. Pfizer, well, that might be a stock I want to own. Okay? Because obviously, it's one of the best in its industry. Now, what do? Well, we roll through and we look at finding these opportunities through scans, through artificial intelligence, where we do look at, is it a first-class stock? Does it have high probability? Does it have the probability cones? Does it have the chart set up that make it a 90% probability on a first-class stock? And if it does, then that's where we'll go forward and make the move. I've already shown you exactly what something like that looks like. Guys, at the end of last year, this is what we ended up with. 70 winning trades, 5 losing trades, 93% probability of success, 65% average premium captured across all the winners and the losers. Okay? It's our Rocket Wealth alert service. If you're interested, then someone will throw something up there for you if they haven't already on how you can take a look to sign up for that service. All right, let's move forward and let's talk about the part deux or part tray of our Flying Five strategy. Now, on Monday, if you were here, I was discussing the Flying Five. I was discussing buying 5 Dow stocks. We were looking at these 5 Dow stocks. What did they all have in common? Well, they were part of the dogs of the Dow. They were part of that situation where we were looking at those top 10 Dow stocks that had the highest dividend yield. Remember that. Of those 10, we were looking at the 5 that were the cheapest. And then the strategy that we started off with Monday was just a simple stock strategy. Buying and holding for a year, these 5 stocks. How has the performance been? The performance has been quite well. Now, last year, they only did about a 14.5% return. And that's because tech outpaced value. These are value plays. But if you go back and look at this strategy all the way back to the year 2000, you'll see that this strategy outperformed the Dow, outperformed the S&P 500, outperformed the NASDAQ by an average of 20% a year. That already is a great strategy when you're looking at some sort of value, some diversification, and outperformance. But what we discussed on Monday was a way to juice the returns. That's right, juice, not that movie that Samuel L. Jackson was in. This kind of juice was juicing the returns and also helping to pad the risk using options. Now, what we talked about on Monday was covered calls. And the covered call strategy was the ability to still buy the stock, still get the stock appreciation, a little bit of it maybe, but also still able to get the dividend payout, all the while selling call option premium against the stock you were buying to do what? to pick up, all right, to pick up some change, some loose change on the ground. And on average, that loose change was coming in at around 10% for the year. Now, remember, let's talk about this for a second. 10% on option premium. When you're buying 1 year, when you're looking at 1 year call options, and you're looking at around that maybe 10% for a year, that's not a lot. All right, you might say, well, gosh, Tom, I'd rather sell 10% option premium in a month. Is there a stock out there we could do that on? I don't know. Let's go find out. You know what I'm thinking of? Let's go look at some option chains on Tesla, because I want to find something that's got some expensive options. All right. Now, January 21 is 17 days away. That's a little more than 2 weeks. And if you look at the monies, you're talking about that's about a five. I mean, that's a little more than 5% right there. If you sold the 11, I'm sorry, those are the calls. If you bought the stock and you sold the calls, you're actually selling about 5%. If you sold the puts, it's kind of the same thing. If you just sold the puts, you're looking at about a 5% premium in 2 weeks. That's because this stock is moving. It's moving like crazy. All right, it was at 900 not too long ago. Now it's at 1150. Might be even higher today. Let's update this to today. All right, here's 1.5. Where's this thing at today? 11.4. Okay, so it's off a few points today, but still, you're talking about premium that within a couple weeks you can collect 5% of the actual stock price. Now, the dogs of the Dow, we're talking about collecting premium that's 10%, but it's not 2 weeks, it's an entire year. Yes, but we're talking about boring stocks. All right. What stocks are boring that we're looking at right now? Well, here's my dividend ranker. There's your top 10, and the ones I have highlighted are the bottom 5, the flying 5. So we're talking about, again, Dow Chemical, Verizon Communications, okay? Walgreens is on that list. Let me squeeze this in a little bit so you guys can see it. Coca-Cola and Intel. All 5 of these have one thing in common, with the exception of Intel getting a little bit of press here and there on mainstream media. All of these are boring stocks. Dow Chemical, boring. Verizon, super boring. Walgreens, I mean, every once in a while, so they come out and they talk about come get your COVID get your COVID vaccine at Walgreens. Come and get our at-home tests because they're in stock right now, but 20 minutes later we're going to be out of stock. That's about all you hear out of Walgreens, and with the exception of the earnings once a quarter. Coca-Cola, boring. Great taste, boring. Intel, probably the least of the boring. Okay? So, because they're boring, their option premiums are gonna be cheaper, right? Because they're boring, they're not gonna make it double in a year or triple in a year, and like a stock like Peloton did that went up to near 200 and is now trading back down in the 30s. You're not going to have the reward, but you're also not going to have the risk. But what we're looking at is a longer-term strategy that has worked over time go back and look at it yourself. Dogs of the Dow, okay? So there you go. So that's what we looked at. We looked at first what? Cover calls. A lot of you in here had the same conversations. Tom, that's kind of expensive. That was like the nicest. That was the nicest on the chat that I had about buying the stock or cover calls. Kind of expensive. All right. I'm not going to share with you some of the other comments that came out. Like the ones like, "Oh, you got to be rich to do that." All right. But I promised you 2 things. I said, A, I'm going to put the stocks up here and I'll take the trade the next day. I'll back run you. And then I said, B, I'm going to show you how to do this with call options, which are a lot cheaper. Well, guess what? We talked about that yesterday. And we talked about calls. And we talked about the difference between, and you know what I'm going to do? I'm going to bring up right now a stock chart on Dow Chemical. Let's say goodbye to Peloton. PTON. Those of you that are with me at 1 o'clock, we're going to hunt for a potential. We're going to hunt for a potential rocket wealth trade at 1 o'clock today. Not saying we're going to find one, but I'm going to show you how we search for them. Okay. Dow, DOW. So DOW, Dow Chemical. Now, here you go. There's that boring stock that's traded from the low 50s to 60. $7 move. And that was actually between November and December, because most of the time this thing sits in about a $4 range. Now it's got a little bit of juice here. All right, little juice this morning. That's great. I got on top of that one yesterday. But you know what? It's not about a day. It's not about a week, not about a month. It's about the year. That's what I care about when it comes to Dow. Now, we did a couple of different trades on this. All right, so what we did was we were looking at, let's look at the options. I'm going to walk you through each different trade today, and then you fill in the blanks for the other four. But here's Dow. What did we do? We were looking at, again, the January 20th, 2023 options, the options that have 381 days to expiration. We were looking to do what? All right. Well, we were looking to sell those call options. Right now, if we were going to sell those call options, let me update this. All right, we're looking at anywhere between the 57 halves and 60s, right? Because that's pretty much where it's been sitting. Now, the 57 halves are going to be closer to the money, but the 60s are slightly out of the money. Let's look at these for a second. So I'm going to work within the 60s for the next few minutes. If I sold the 60 call, what's that graph going to look like? Well, it's going to look like I'm crazy, because that's a call. I'm selling a call option. That's not profitable. I have to pair that with the stock. So let me go ahead and set this up to the actual trade we were discussing, or very close to the one we were discussing on Monday. We were talking about going long 100 shares of stock for every call option that we sold. Okay. Now let's risk graph the combination. There you go. So the trade to buy 100 shares, this is right now, to buy 100 shares of the stock and sell that covered call is going to cost $5,300. And again, that's where the comments came in. Do you have something cheaper? Let's look at something cheaper. Let's go back to the stock and option tables again. I'm going to clear everything out. And now we're going to look at buying the 60 calls. Now, actually, I'd like buying the 57 halves more. The reason why is that if the 60 calls are trading for $5.30, let me zoom this in so you guys can see this. If the 60 calls are trading for $5.30 and the 57 halves are $6.43, the 57 halves are a little more than $1 more, $1.13 more, and look what you're getting. You're getting $2.50 in the money, farther, in your favor. And for that, you're going to pay $1.30. If you look at the 55 calls, they're $7.70. Now, what happens there? From $5.30 to $7.70, it's going to cost you $2.40 more, but look what you're getting. You're getting 5 points in the money. This is actually called buying something that has intrinsic value or real value. Let's stick with the 57 halves here. So if I bought the 57 half, what am I doing? Okay, I'm trying to take advantage of the flying five. This trade's only going to cost $643. That's the most I stand to lose on the trade. I do need Dow Chemical to move. I need it to move higher because I'm not going to get the dividends. I know that. I need the stock appreciation. But you know what I got in place of that? I don't have to shell out $5,300. I'm shelling out about 85% less. Let's take it one more time. I want to talk about today what we can do to make this look even better. What we can do to make this look even better is call spreads, the poor man's covered call. And what we can do is by buying that lower strike call option. Okay, let's stick with the Jan 2023 57 half calls. So if I bought the 57 half calls for 2023 for I'm going to use the same price that we see here, 643. And let's say I went out and I sold the 62 half calls. That's a -1, okay? Buying the lower strike, selling the higher strike. I'm going to pay for this one. I'm going to take in $4.33 for the 62 half call. All right, here we go. So let's risk graph this, and I'm going to take a look at a couple differences here. All right, so this is all about risk reward break even. When we set all of this up, that's what it's all about. Risk reward break even. Okay, so if I'm looking at the actual stock price, well, my risk on this trade, my break even is $53.11 when I buy the stock and sell the covered call. Do you know why? Look, the stock's trading where? The stock is actually trading at, let's bring up the Dow, the stock chart of DOW. All right, there's Peloton again. Let's get that Dow stock up there. That's more important to me. So right now, Dow Chemical is trading at $58.94. Let's call it 59 because that's pretty much close to where it is. So let's call it 59. Well, if I have a graph, if I'm buying and my break even is 53.11, I'm already below break even. I have a higher probability between now and the end of the year, all right, that the stock's going to be at or above my break even. Now let's take a look at the option trade, the call option trade. The break even on Dow Chemical by January 2023 is 63.93. Stock's already trading close to 59. This is great. We need 4 points of a move and we're break even. All right, but that's by the end of the year. You get 4 points of movement here in the next month or two, this could be up 50%. There you go. Now let's take a look at the last graph. The last one we're looking at is the spread. The spread, we were looking at buying the 57 half calls and selling the 62 half calls. Buying that slightly in the money call and selling the slightly out of the money call, okay? We can call this a number of things. This is a bull call spread. This is a call debit spread. This is a leap call spread. This is almost like going long the stock synthetically, because do you see that number just above my red arrow? Let me put the red arrow up a little bit more. You see that downside, upside break even? Isn't that really close to where the stock price is right now? If the stock's at 59 and I only got to go 60 cents to break even, heck, that can happen in a day. And yet we have a whole year for this to happen. All right? So, you tell me, which of these three strategies on the dogs of the Dow / the Flying Five do you like? Do you like the covered call because of the ability to grab dividend and option premium? Do you like the call option itself because you have unlimited profit potential? Or do you like the poor man's covered call, bull call spread, call debit spread, call leap spread, synthetic long position I'm showing you right now, where you are putting, by the way, I didn't even tell you how much this trade is going to cost, did I? $210 is what the print looks like right now per spread contract. Not $5,300, not $643, $210. And oh, by the way, did I mention this? 138% maximum profit potential. Not 10%. I mean, unlimited is what you look at on call options, but let's face it, that unlimited is only there because the software program can't come up with the math. It can't come up with where the stock is going to possibly be. With a spread, you know what your maximum reward is. You know what your maximum risk is. All right? So I'm going to put the trade up there one more time. I'm just going to throw it up there on the screen. All right? And again, guys, you can take what I just showed you and you can now emulate this to Verizon. Coca-Cola, Intel, that other one. I don't even remember what it was. Let's go look and see. Walgreens. And of course, Dow, which we talked about already. All right. So, questions, comments, etc. What are the rules for managing these trades? You don't have to. Dogs of the Dow is a strategy where it is a fire and forget strategy. If you're doing the covered call trade, then you're basically looking at this. This is a year by year by year, almost a decade by decade strategy. Now, if you're doing the call options, maybe you use a 50% stop loss. If you're doing call spreads, you've got the stop loss built in. Look at this. Instead of paying $643, you've reduced your risk by 2/3. I'd say that's a pretty good stop loss. What do you think? All right. So there you go. So that is that's Dow Chemical. But you can put this on. How do you pick the strikes? Well, what we look at is, take a look, for instance, Shar, that if I were selling call options, I'm getting about 10% premium for those at the money, those near money calls. So what I like to do is I like to make sure that what I'm selling, AKA the 62 half calls, are really no more than 10% above the stock price. And this one, we're not 10% above the stock price at all. We're really like 5% above the stock price. So that's, if the stock's at 59 and you're selling the 62 half call, that's pretty good. I mean, you're looking a 5% move in the stock and you double your money if it happens over the course of the year. All right. So that's an idea, what I use for ideas in terms of strike price. What's a good book or books video to learn about call options, puts, etc.? Let's see if I got anything in here. Boy, I got so many books. I've written a few of them. You can go out to Amazon, the original bookseller, Google my name, and Google Options Course, the Options Course by George Fontenilles and Tom Gentile. There's also some other ones out there too. And even not just me, but, Options for Dummies is a great place to start as well. All right. But, those are some good places to start. But you know what? I'm going to be here. And what I'm planning on doing, guys, going forward, we're doing a schedule change next week. All right. So I'm going a little bit later. I'm going to be a little bit later on the broadcast on Monday, Tuesdays, and Wednesdays. Monday and Wednesday, I'm going to get into cryptocurrency with Nick Black. On Tuesdays, I will be doing this kind of stuff. All right. I will be going in and I will be doing options-centric classes with you. And sometimes we'll talk about calls, and sometimes we'll talk about puts, sometimes we'll talk about spreads, sometimes we'll talk about the buy side versus the sell side. And then I will be giving you examples coming right out of our alert services, coming right out of Money Calendar, coming right out of our darknet strategy, okay? Coming right out of things like Rocket Wealth, Operation Surge Strike. We'll talk about when's the best time to buy a call option, because I think there are better times to buy a call option than put options, etc. Okay, so my plan is to take every Tuesday with you, Tuesdays with Tom at 11:30 starting next week, and we will dive into as basic as I can get, but at the same time showing you how to put these on using winning trades. So that's our plan starting next week, guys. Next week, I will be on at 11:30 and then again at 1. 11:30 to 12:30 Monday, me and Nick Black. 12:30 Tuesday, me, myself, and I. Maybe I'll have a guest on, I don't know. 11:30 to 12:30 on Wednesday, me and Nick Black once again. Monday, Tuesday, Wednesday, also at 1 p.m. I'll be back, and I'll be talking to our members. We'll be in our members-only rooms then, discussing our strategies like I'll be doing today at 1 o'clock. So those of you that want to come in, you know what? We're actually opening it up today. So those of you that follow me through Fast Fortune or follow any of our services, come join me at 1 o'clock today, because I will be talking about Money Calendar. I will be talking about Rocket Wealth strategies. We're going to be getting into a lot of trading concepts at 1 o'clock today. So come join me at 1, And till then, have a great rest of your morning. I believe Mr. Chris Johnson's up next, so I'm going to turn it over to him. We'll see you. See you later. Goodbye, guys. 1 o'clock today. Be there. Be square.